Why is cost basis important for capital gains tax? Imagine you buy a piece of art, a house, or stocks and later sell them. Do you know how much profit you actually made? That's where your cost basis comes into play. It is the starting point for figuring out how much tax you owe when you sell an asset. Your cost basis is the amount you originally paid, including any fees or expenses directly related to the purchase. For stocks, this can include broker commissions. For real estate, it might include closing costs or improvements. When you sell, the difference between the sale price and your cost basis is your capital gain or loss. If you sell a stock for more than what you paid, you have a capital gain. If you sell for less, you have a capital loss. The IRS taxes your capital gains, so knowing your cost basis helps you determine how much tax you need to pay. For example, if you bought stocks for $1,000 and sold them for $1,500, your gain is $500. But if you paid $50 in commissions, your actual cost basis is $1,050, making your taxable gain $450. The higher your cost basis, the lower your taxable gain. That means you pay less in taxes. If you don't keep track of your cost basis accurately, you might pay more tax than necessary. Many Asian American families invest in stocks, real estate, or receive equity compensation. Knowing your cost basis helps you plan for tax season and avoid surprises. There are different ways to calculate cost basis. You can use the first in first out method, where the oldest shares are sold first. Or you can use specific lot identification, choosing which shares to sell based on their purchase prices. Some people use the average cost method, especially with mutual funds. Each method can result in different taxable gains, so choosing the right one can help lower your tax bill. Sometimes, your cost basis needs adjusting. If you make improvements to a property, those costs increase your basis. If you inherit an asset, your basis is usually stepped up to its value at the time of the previous owner's death. This can reduce your taxable gain when you sell. Tracking your cost basis is especially important for retirement and investment planning. It helps you decide when to sell assets and how much tax you might owe. If you hold an investment for more than 1 year, you may qualify for lower long-term capital gains rates. Knowing your cost basis helps you figure out your holding period and plan your sales accordingly. In the end, your cost basis is the key to understanding your actual profit and how much tax you will pay. Accurate tracking helps you pay the right amount of tax, avoid overpaying, and make smarter investment choices. For Asian American families focused on smart tax planning and preparing for retirement, managing your cost basis is a simple but powerful step toward financial success.